Good afternoon, everybody. Gonna take a minute to let folks get in here. I'll set the stage for our discussion and we can get going a little earlier than we otherwise would have since GameStop won't be hosting a conference call at 5 o'clock today, Eastern. I am going to read a disclaimer for those of you who haven't had the opportunity to tune into any of the spaces that we host under the Wook Capital account. For those of you who don't know me, this is Rod Alsman, Managing Director at Wook Capital Management. My personal account I have in the audience. I'm just going to read this disclaimer here. Want everyone who's listening to know that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from a professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual and the specific responsibility of that individual. Okay, with that mouthful out of the way, welcome to our quarterly presentation of GameStop's earnings call, or earnings in this case. There's some meaningful news out of the company this afternoon. We're going to kind of review what the financial results looked like. I'll pontificate a little on what's happened and what it may mean going forward, and then I'll welcome folks who want to come up and ask questions or chime in on the results. So just to set the stage again a little bit, for those who don't know, Wook Capital is a family office that was founded with the investment thesis that crowdsourced research is something that individual investors can collectively work towards achieving investment alpha through. And we wouldn't be here today if it weren't for GameStop. Wook represented at one point, as far as we know, the largest retail investor holding through till Jan 21, at which point, the magic happened and led us eventually to here. So in terms of going back to where is GameStop right now, we've got two filings that came out this afternoon, two press releases. First one came out around 4:05. And the initial reaction, if you are looking at the after hours stock chart, was one of a quick blip upward. Shares rallied up to $29, just shy of $29, only to begin dropping, and they've been dropping throughout the after hours session, now trading down to about $20. So the news was that Ryan Cohen has been elected by the GameStop board of directors as executive chairman effective immediately. His responsibilities include capital allocation and overseeing management. So it appears as though Cohen will be more engaged with some of the ongoing both strategic decision-making from a capital allocation perspective as well as managerial oversight than perhaps he was previously. So Matt Furlong, the former CEO, though, has been terminated. And he had been CEO for about 2 years. So he is no longer the CEO. There is no announcement of a backfill for him. And we know now that Cohen's role has been expanded from chairman of the board to this executive chairman role, which I don't yet see the SEC filing out on their website. They did release a press release that notes a few items from the first quarter results. So first things first, we've got sales. Net sales were $1.237 billion for the period. That 1.237 is lower by about 9% from what the sell side consensus showed. Remember, at this point, the company's only covered by, I believe it's 3 sell side analysts, many of whom have given up on covering the company. So relative to that limited population, it was a miss against the consensus on the top line. There were some positive signs, though. Gross margin has improved year over year. So the gross profit margin last year, first quarter 22, was 21.7%. That profit margin percentage has expanded to 23.2, so 150 basis point improvement year over year in their gross margins. So miss on sales, improvement in their gross margins, further improvement in their selling, general, and administrative expenses. So their overhead costs have also come down, but unfortunately, they're not getting the benefit of any leverage on that cost because of the decline in sales, as well as even with that improvement in gross profit percentage, gross profit dollars were down about $11 million year over year, from 298 to 287 million. So taking us down to the operating line, the loss is less than last year, but for the first quarter, there is still an operating loss of $58.4 million, which, since the company has a significant cash balance, it is accumulating interest. So it has an interest benefit, an interest income benefit rather than expense. So that operating loss actually comes down from 58.4 to 50.6 after we account for the income from interest as well as some other expense, and then the net loss with $100,000 in tax benefit is 50.5 million for the quarter. So it's pretty in line with what the analysts had called for from a operating margin perspective. The consensus was for a $56.4 million loss at the EBIT line. The loss was 58.4, so $2 million miss. Which again, it highlights that there was the big miss on sales, the 9% miss on sales, but those gross margins as well as those overhead cost takeouts appear to have been better than sell side had modeled. So that's why you're seeing the operating income miss being slimmer. The loss per share, the EPS estimates were for a negative 12 cents, and there was a negative 17 cents, so a little bit larger. So all in all, I think this quarter raises more questions than answers. You have a continued improvement in the cost structure of the business. Unfortunately, though, the business is still facing the ongoing realities of the secular headwinds, especially in physical software. So if we look, the company does disclose a breakout of net sales. For those who've been around the company for a few years, back in 2019, they went away from disclosing pre-owned, which pre-owned is historically has been a primary driver of the company's gross profit. So we don't get a breakout of pre-owned anymore. We haven't for 3 or so years now. They lump pre-owned into the software category. There are 3 categories. There is hardware and accessories, software, and collectibles. Software sales declined meaningfully year over year. So remember, a couple big games came out. You had Zelda come out in early May, but this quarter is through April 30th. So the benefit of any outperformance in terms of those results are remain to be seen. We'll see in second quarter earnings results. But yes, software down meaningfully year over year. Percent of total sales last year, software represented 35% in this first quarter. In this year, it's only 27%. So a big shift toward hardware and accessories category, which is generally a lower gross margin. So it's actually interesting that they saw gross margins improve year over year despite the unfavorable mix shift. So I do think that shows that they've really sharpened their pencils, so to speak, on pricing and they've discussed in the past trying to get better terms with their vendors. So again, we won't know much additional detail unless we review the 10Q, which I'm going to go back and refresh and see if that's out. But it wasn't last I checked. We just have the earnings release. Okay, I see an 8K, but I don't see the 10K yet. So, sorry, the 10Q yet. So let me continue then. Hardware and accessories mixes saw a big boon in terms of dollars, up year over year. Percent of total sales mix rose almost 10%, from just shy of 49 to just shy of 59%. Other kind of negative data point is collectibles. So collectibles, you think all of the toys, board games, knickknacks, that the company sells both in store and online. Those are typically higher margin than their hardware and accessory products, as well as their new software sales. Collectibles was down in terms of total sales mix from 16% to 14% year over year, almost a $50 million decline in terms of collectibles sales. You think collectibles, right, is even, of course, video gaming in general is a discretionary item, but the collectibles category in particular is especially discretionary. And typically, the management in the past, prior management, since current management doesn't tell us much, but prior management would discuss how collectible sales benefit meaningfully from foot traffic. So this could be a sign. I know I had seen different analysts sharing, Placer.ai is a foot traffic kind of service that uses cell phone data. I had seen that the Placer.ai data had showed weakness in terms of physical foot traffic to the company's stores year over year. So it does look like that kind of alternative data is borne out in the real data. So yeah, I mean, the highlights of the quarter, just to kind of sum it up, are continued cost cutting at the overhead level, improvement in the gross margin profile of what they are selling despite unfavorable mix. The negative, I think, is now this uncertainty around who, if anyone, will be the new CEO of the company. Clearly, the fact that he was terminated implies a decision was made that whatever trajectory management thought they were on, the board decided was not satisfactory. So, yeah, another operating loss. Typically, for GameStop, it's important to kind of bear in mind how seasonal the business is. The fourth quarter, this preceding quarter had a better result than expected, which for those of you who follow it closely may recall in March, the stock shot up from about $17. It opened around 27 the next day. So last earnings was a big shock to the upside. I think the stock had run up meaningfully into this earnings, and now with this news and this somewhat unimpressive result, the stock's trading down again. It's around 21.20 at this point in after hours, so a pretty meaningful drop of high teens % after hours. That we'll see where the stock opens tomorrow. But yep, there is no. Just to recap, there is no call. The company replaced, or rather terminated, the CEO, and they pointed us to the 10Q filing for further detail, which I'm going to go straight to the SEC now and look on Edgar and see if there's a filing there. Generally, that's a great initial system to start out. I'm on the GameStop site, and yeah, I'm on the SEC's Edgar page, and I do not see this most recent 10Q yet filed with the Securities and Exchange Commission. So there's only so much to be said. I've kind of recapped what they disclosed, the income statement, just to talk about the balance sheet a little bit. I mentioned they generated interest income because they do have a meaningful cash position. In terms of the change year over year, cash was basically flat, but they do have a little over $250 million in marketable securities. They've really taken. They've really, from what they've said in prior quarters, they've taken we will potentially be opportunistic in M&A. So they kind of have this cash pile sitting there, which is giving them optionality. It's helpful in that a lot of other levered retailers are struggling right now. So of course that balance sheet was refreshed by virtue of significant cash flows from financing from 2 at-the-market offerings in 2021. The company is, again, yet to really show that this reinvigorated, transformed business can generate meaningful operating cash over a full year. I've started talking about the seasonality. I kind of distracted myself, but the seasonality being that 4Q, the holiday from December, January, November, that is really, for GameStop in particular, it's like almost 40% of net sales. It's a very high mix of net sales historically. It's among the highest the most seasonal businesses of any publicly traded retailer. So consider that it's really going to be make or break when you think about the company from a full year perspective. Okay, they're now 50 million in the hole on net income. They'll likely lose money in the second quarter. Third quarter will be somewhat better, but then the fourth quarter is where they're going to look to make up most or all of that, just given the way their business works. So it's not uncommon, even in their heyday, first and second quarter are weaker, but just kind of bear that in mind. You can't really analyze this company on just a quarter to quarter basis. I think you do need to consider that. But yeah, the balance sheet remains fine. There's no real debt. They have the 26 million in long-term debt that they've noted is related to some French COVID. I think it's low or no interest COVID loans. So meaningful cash position, no debt. They do have optionality, but again, the valuation is still, at the close today, it was almost $8 billion market cap. Again, we're talking about a business that has yet to show that it can sustainably generate positive free cash flow over a full year. So I think it makes sense why the stock's trading down. The price clearly got very ahead of itself in the last month or so, and this news, this uncertainty around the CEO vacancy isn't that helpful. So just briefly, I'll review the cash flow statement, kind of impacts. We can see that there was an additional about 103 million in cash used in operations. Part of that was a bigger buildup in merchandise inventories than the prior year. So it looks like a chunk of that is changes in working capital. The prior year had its own noise with accounts payable, and I don't want to go into the weeds on that, but again, they're still consuming cash in the operation. The total decrease in cash for the quarter was about 116 million, and that does leave them with cash equivalents and restricted cash, which doesn't include marketable securities, of about $1.08 billion. So again, at this sort of cash burn rate, for the full year, I'll see what the analyst consensus show. For full year, if my data can update, we have an estimate for about 100 million operating loss. So that's not going to be one for one with cash flow, just because of working capital noise and whatnot, as well as of course any investments, which does not look like they made about 9 million in capex. So in this quarter, not meaningful, and it's down somewhat year over year. So yeah, I mean, there's no imminent solvency issues whatsoever because of the refreshed balance sheet. There's also no indication to me of a change in the underlying business that would better align how it's priced today by the market and with the underlying operation. So in my view, it does remain disconnected from fundamentals, but I'll leave it at that. So, okay, with all of that said, my little 20-minute or so rant about kind of what we have. I'm refreshing Edgar one more time. Okay, the queue is out, so can see if there's anything interesting in there. But I've got JP on my team up here as a co-host. If anyone in the audience wanted to ask any questions, I'm going to try and skim through the queue. I know one data point that a lot of some of the Reddit crowd really like is on the direct registered shares. I know they changed the language last earnings. I'm trying to just find that if they are still disclosing that data point. But yeah, if anyone has any questions, please feel free to ask. I'm just going to try to find that. I'm not sure if they took that language out. I searched for several different words that I thought would cover it. I'm not seeing it. So perhaps they decided to remove that language from the quarterly filing, unless someone has seen otherwise. Oh, no, somebody found it. Thank you, Kyle. So, yes, that's right. In the last quarter, they changed this language to refer to seed and co. So, of the 300, just shy of 305 million shares outstanding, about 228 of them were held by Seed & Co. on behalf of the DTCC, approximately 75% of outstanding shares. 76.6 million shares were held by registered holders with our transfer agent as of June 1st. So let me see in the K what that shows, because I don't follow that stuff so closely, but see what that looks like. So quarter over quarter, then, the direct registered share count rose from 76.0 to 76.6, so a 600,000 share, slightly less than 1% sequential increase in the DRS shares, so to speak. And that is from March 22nd till June 1st. So I know that data point's important to some folks. Let's see. I'm just scrolling through the queue, which just came out a few minutes ago, to see if there's anything else of note. But again, just to recap, the sales miss versus sell side consensus was about 9%. The operating income miss was narrower due to the company beating on gross margins as well as on operating margins due to the reduction in their overhead expense, as well as them facing some unfavorable sales mix comparisons year over year due to the decline in software sales, as well as collectibles sales. So we'll see in the second quarter, as I mentioned earlier, the Tears of the Kingdom, which if you haven't played the game, is absolutely fantastic. I've only put about 5 or so hours into it, and it is a blast. It is just a delight to play that game. So if you have a Switch, it's a must play, in my opinion. GameStop was running a pretty impressive promotion. It was trade a select 2 games for $50 towards the game, which retailed at $70. So, you found a couple old games that qualified for that, and you had your $5 Pro, you might be able to get Tears of the Kingdom for 15 bucks out of pocket, which is what I did the other day. Anyways, excuse me. Nothing else is really jumping out on the cash flow statement that we reviewed. They're not saying too much in here that I can see new. During the first quarter of fiscal 23, we committed to a plan to sell additional property in our Europe segment consisting of a warehouse building and land with a total net carrying value of 6.5 million. There were no impairment charges. So it does look like that they've entered into an agreement in April. It did not close, but the assets were held for sale at the end of the quarter, and they do expect the transaction to close in the third quarter. And that agreement is for 13.1 million. That is the sale of their European warehouse building, land, and other property and equipment. So the European business for many years has been a weak point for the company. The prior management had gotten out of Scandinavia, had been reducing their exposure, and other Irish businesses being closed. They have some, I think, solid performance in GameStop Italy. They've got the business known as Micromania in France, but by and large, that European business has been a laggard within their kind of geographic spread for years now. So it's nice to see them selling some of these assets, potentially setting up a subsequent transaction, otherwise just at least monetizing that warehouse. I believe it is in Milan. Followed this company for too long. Let's see if there's anything else interesting here. in the queue. Somebody had, hey, did they have an uptick in, um, in cash from maybe higher numbers of pre-orders of Tears of the Kingdom, for example? So I believe that shows up in their unredeemed customer liabilities, shows up on the liability side of the balance sheet, and they would have that cash just there until the customer ended up converting it into a sale. But I don't see anything that looks meaningfully different from that year over year. In terms of the securities they are holding right now that I mentioned, the 250 odd million, it's U.S. government securities comprise the vast majority of their held to market assets. So they are, they earned, as I mentioned, I think about, what was it, 8 or 9 million in interest income in the quarter. So if you annualize that, it seems like they're earning maybe figure around a 4% ish rate on that cash. Maybe a little bit less, I guess, because it's $1 billion in cash plus the $250 million in marketable. But figure that number should go up a little bit since they are carrying that big cash balance. But it should be relatively immaterial in the big scheme of things. Obviously, it doesn't impact the operation. Yep, the debt is still just the French term loans, which are very low interest. The interest rate increased from 0 to 70 basis points and 1% for the remaining. So again, no reason to pay down that debt. Let's see. Okay, that's the management discussion and analysis section. Let's see if we have anything new here. GameStop entered a new phase of its transformation during the second half of last year, focused on establishing omni-channel retail experience, achieving profitability, leveraging brand equity to support growth, taking steps with an emphasis on cost containment, improving margins through operational discipline, increased emphasis on higher margin collectibles and pre-owned product categories, ensuring the company's cost structure is sustainable relative to revenue, including taking steps to optimize our workforce to operate efficiently and nimbly. That sounds like reducing labor cost. Prudently increasing the size of our addressable market by growing our product category across PC gaming, collectibles, consumer electronics, toys, augmented reality, virtual reality, and other categories that represent natural extensions of our business. That's interesting. I wonder if they'll be selling the Apple Vision Pro. It's a very high cost item, and I'll be curious to see if they decide to carry those in store for consumer, trying on, and kind of that experiential try before you buy. You figure in-store retail does have a competitive edge when it comes to that sort of a thing. Obviously, it doesn't obligate the consumer to buy it from them, but let's see where they go with that. Sustaining a superior customer experience supported by a seamless in-store and e-commerce experience with speedy delivery to our customers. So in connection with our cost reduction efforts, we expect to see favorable impacts to our SG&A expenses in the quarters to come as we pursue profitability. We also maintain and continue to strengthen our strong balance sheet. As part of our efforts to achieve sustained profitability, we continue to evaluate our portfolio of assets to validate their strategic and financial fit and eliminate redundancies. And then they're referring to the process of exiting the Irish operations I just mentioned. We expect our intense focus on expense reductions to yield decreases in SG&A expenses. They note they may incur severance, store closure, and other related costs. So they'll continue to call those out. We continue to explore strategic options, which may include further store closings and exiting unprofitable businesses. I'm going to scroll a little further down then to just see where the geographic sales look like. So on page 15 of the Q, you've got the geographical breakout. So the US is still the vast majority of sales for the company, about 2/3 of sales. Europe actually saw a marked uptick in sales year over year. I'm a little surprised by that. I guess last first quarter there was a war that commenced, so that could have been some of the weakness from Europe in the preceding year. But yeah, Europe represented about 18% of sales in the quarter, Australia 9, Canada 5. So they are not, though, breaking out segment level operating income for the geographies. They're just disclosing net sales, which I'm just looking through the 10K. They used to disclose, or at least in the 10K, they disclosed both net sales at the geographic level as well as operating loss or income, D&A, any asset impairments, and CapEx. So it appears that they're reducing their disclosure further and only now disclosing sales at the geographic level. I will note that last year, Europe saw about a 3% operating loss. So they lost about 30 million on 900 million in sales. And Europe has been losing money for the preceding 3 years. So going back to that comment about exiting unprofitable geographies and the fact that they are selling the warehouse in Milan makes it a little more likely that we could see further restructuring of the European business. I'll just call out a couple other things then. So, okay, they do cite the reason for the increase in Europe net sales was primarily driven by hardware gaming revenue. So there were supply constraints last year. Those PS5s were hard to get. So alleviating those supply constraints pushed up revenue. But again, they're no longer disclosing anything but revenue at the geographic level. Their gross profit, which I mentioned, improved 150 basis points year over year. So, okay, yeah, a lot of the stuff I said earlier, the decline in gross profit is primarily attributable to the impact of lower net sales, a shift in product mix from pre-owned gaming hardware and collectibles into new gaming hardware, partially offset by a decrease in freight expenses as a result of lower e-commerce volume and added cost optimizations. So there's a little nugget. Even though they don't disclose mix of e-commerce sales, we can infer that e-commerce volumes were down year over year. Just the sales numbers themselves kind of lead one to conclude that. But again, when you're kind of looking through these cues, that's some of the language you want to look for. The profit percentage was primarily increased due to the decrease in freight expenses driven by added cost optimizations. And then the SG&A cost reductions that I've noted, the percent of sales fell from about 33% to about 28%. So they note they expect that to continue, and that it was primarily attributable to a reduction in labor-related and consulting service costs driven by our focus on cost structure optimization efforts and the translation impact of a weaker US dollar. I think that's about it. There's discussion on where the cash flows are going, yada yada, but yeah, that's about it in terms of anything meaningful that I see in the queue. So okay, it's 5:03 again. We don't have an earnings call today. The company has terminated its CEO, Matt Furlong, and Ryan Cohen, who was previously the chairman, is now an executive director with, it appears, broader responsibility or increased responsibility for capital allocation and for management. Currently a CEO vacancy, and the share price is down to $21.62, down 12.4% on the day, and down about 18% in after hours. Okay, that's about all there is to say, at least as I see it. Very happy to answer questions on any of those operational metrics or other. I think I recapped it a few times, but yeah, it's a sales miss. It's a beat in terms of gross margin and operating loss, or kind of a meet on operating loss. And the DRS share count rose a little less than 1% quarter over quarter. Okay, it looks like there's one other personnel change. Mark Robinson is the new principal executive officer of the company with the title of general manager. Okay. I guess that is in the 8K. I'm guessing someone pinged it to me. Okay, yes, it is in the 8K that came out. The board reduced to 5 with Mr. Furlong's resignation. Mark Robinson is now the company's general manager, effective immediately. Don't know Mark Robinson. Mr. Robinson. Okay, that's right. Mr. Robinson was formerly the general counsel. I think he was in the. Hang on a second. So he will continue to serve as general counsel and secretary, and he now will report to Cohen, the executive chairman, as the general manager in addition to the general counsel. Very interesting. Not too often. First time I've ever heard of a general counsel also being a general manager, not called a CEO, and reporting to an executive chairman. Cohen likes to do things differently. So, yep, I think that's about it then. Anyone have any questions, comments? I'm trying to look at a few different screens and see if there are any text-related queries. I'm not seeing any. Thank you again, Kyle, for pointing out that we got that detail in the 8K. Just to recap, we already walked through the queue that had come out, and the company's not holding a call. They've replaced Matt Furlong with Mark Robinson, who will report directly to Ryan Cohen as executive chairman. All right. Well, not seeing any requests then, you please feel free to check out the replay if you'd like to hear the discussion on the operating results and the detail from the 10Q. We will continue to broadcast these quarterly calls. GameStop holds a very special place in the hearts of everyone here at Wook Capital Management. Wish the best of luck to Mr. Robinson, Mr. Cohen, and we look forward to seeing how they do in this second quarter. Hope everyone has a great rest of their day. Stay safe out there.